We keep hearing that consumers are cash-strapped and pushing back on high prices. But like I told you last night, it's not that people have stopped spending on everything. It's that they've gotten more selective, always searching for the best bargains. And we've seen this from restaurant after restaurant. Yet somehow, last Thursday, DoorDash managed to report a spectacular quarter. DoorDash, the borderline extortion online food delivery service that we all adore, or at least I do, and it's my show, is looking pretty interesting. The stock shot up 8% the next day, even as the market melted down. By the way, we heard the same thing from Uber. Their Uber Eats business is on fire, which helped that stock to rally 11% on Tuesday. Later that same day, Maple Bear, the parent company of Instacart, reported its own excellent set of numbers, allowing the stock to gain 3% yesterday. Now, it doesn't even matter that Maple Bear is a ridiculously stupid name. All the better to get the word out, I guess. These online delivery services may be convenient, but they do offer what I regard as terrible value. So how the heck are they doing this well in an environment where the consumer is supposed to be rebelling against high prices? Why don't we start with DoorDash? Last Thursday night, they surprised to the upside with better than expected numbers for every key line item: total orders, gross order volume revenue, and contribution profit. DoorDash delivered 23% revenue growth, while with rising margins translating into strong earnings for interest, taxes, depreciation, and amortization. Plus, management gave you very healthy guidance for the current quarter, substantially better than expected, especially on the earnings front, how they pull this off. On the conference call Q&A session, that was the first question posed to co-founder and CEO Tony Xu, because it seems crazy that DoorDash is doing great when restaurants are seeing softening demand all over the place. Xu pointed to two main factors. First, he explained that digital ordering is still in its early innings. Even though restaurants may be struggling, digital remains a huge source of growth for the industry, even if they're hobbled by lower in-store traffic. He's confident about this because even as DoorDash digital penetration is still in the single digits, and outside of their network, it's even lower than that. Incredible. Second, Xu pointed out that DoorDash's service continues to improve. In fact, order frequency and customer retention are just as strong, if not better now, than they were during the pandemic when you were locked in at home. Plus, he noted that DoorDash has the lowest cost logistics network in most places in the United States, and customers are desperate to sign up for their Dash Pass subscription, where you pay $9.99 per month to get delivery fees waived for orders over $12. I think there's one more key driver here, though, which is that many people got so used to the convenience of these delivery apps during the pandemic that they're now seen as a necessity. Yep, this looks like a lasting behavior change from the pandemic. In fact, people paying up for food on DoorDash could be a major reason why they have less money to buy everything else. Either way, this company is doing great. And Xu, what can I say? He's a fabulous executive. He's great friends of the restaurant industry. Or now, how about Uber? Well, it was over a great quarter. It was just a great quarter overall for the company. But right now, I want to focus on just one segment, which is called Uber Eats, where gross bookings grew by 16%. Revenue came in a little light at 8%, but EBITDA expanded by 79%, coming in much better than expected. Their guidance for the current quarter was also solid, although also slightly lower than expected. Give them a break. When Uber CEO Dara Khosrowshahi went on Squawk Box on Tuesday morning, he had a lot of interesting things to say. For one, he pointed out that his business has a counter-cyclical element, because when the labor market gets weak, more people want to drive for Uber and Uber Eats. That helps improve the service, because when they have more drivers, the users get shorter wait times and better pricing. But in terms of Uber Eats, Dara explained that deliveries become a sticky habit, for the consumer. And at the same time, while the prices are high, you get a much better deal when you sign up for an Uber One membership, which gets you 0 delivery fees for Uber Eats. He says over half of the delivery volumes come from members. So like with DoorDash, online delivery is only extortionate for the people who don't pay a small monthly subscription fee. On Uber's conference call, the CFO actually said he was surprised to see just how sticky the food delivery business has become. And it seems to be getting even stickier. Listen to this, quote, "I look back 5-6 quarters of data, and it gets better every quarter in terms of eater retention," end quote. Pandemic habit, convenience means more time, and post-COVID time is now the currency of the realm, not so much money. Finally, let's talk about Instacart. I mean, Maple Bear, which I haven't been following as closely, because the stock hasn't had much going for it since it came public last year, and because it's hard to take a company named Maple Bear seriously. A great name for a stuffed animal, though. All right, this was a solid quarter from them. Instacart's gross transaction value grew 10% year over year, better than expected, with total revenue up 15%, also very good, and 89% EBITDA growth, just terrific. On top of that, management gave you robust guidance for the current quarter. In its shareholder letter, Instacart noted that roughly 25 million people used their service over the past year. And the company said that this gives them, quote, a tremendous opportunity to deepen engagement with infrequent customers while continuing to attract more new users to Instacart, end quote. Will it work? Well, you know what? I'm still taking a bit of a wait-and-see approach to Instacart. That's been my attitude since the IPO last September. And by the way, you haven't missed anything. Stock's down almost 5% since I told you to steer clear 11 months ago. I think the grocery delivery business is a tough market. No one's been able to achieve huge success here, even Amazon with its Whole Foods subsidiary. People are used to ordering meals like they order food from a waiter at restaurants. But most of us still prefer to buy our groceries in person, especially if you're shopping for meat or fish or produce. You know, I like to feel the stuff. That said, even Instacart's putting up extremely solid numbers, so clearly millions of people appreciate this convenience. After looking over these strong results from DoorDash, Uber, and Instacart, I keep returning to one thought. It's the fact that meal delivery seems to become an ingrained habit during the pandemic, heck, even before the pandemic, but especially during the pandemic. Both DoorDash and Uber called out the things like order frequency and customer retention are not just holding up, they're actually improving. More important, people seem to see delivery as a necessity rather than something discretionary, which is why these companies can put up great numbers when the restaurants are struggling. Oh, and they know that restaurants mark up liquor ferociously. So it's much cheaper to chow down at home, crack open a cold one, put the Olympics on your 70-inch screen, and never leave the house. Sure, all three food delivery companies called out the fact that customers are prioritizing affordability, and they're trying to give the people what they want, often via membership programs that remove delivery fees, and that's important. But the bottom line, DoorDash and Uber Eats and Instacart can only put up numbers like these because food delivery has become a calcified habit for so many consumers. People who value their time as much as they value their money. No wonder people don't have excess cash to throw around. They're spending it all on DoorDash. Jihan in Florida. Jihan.
Hey, booyah, Jim.
Booyah, what's up?
Jim, I have my son Jian here who has a question for you.
Sure. Why not? Booyah. What do I think of Costco? Oh my! With the gold bars in the morning, with the unbelievable bargains, the 3,000 different shopkeeping units. I tell you, that stock, which had a great month last month, is a buy. And Jian, let me tell you something. Your kid, highest compliment. Got horse sense.
He is the kid.
Oh, he's the kid. Jian's the kid. Hey, Jian, you got horse sense there. I got a little confused between the parent and the kid there. All right, Bob in Illinois. Bob.
Yes, sir. I've been a holder of Kava for quite a while. Lately, it got up to around 80, and then it's really been fluctuating in large increments, like 3 and 5 points a day. Do you think this is a good time to get back in?
Well, I'd like to hit it on a day when it has a big downdraft, because exactly what you said. It has these bizarre moves, and maybe you can get in. I mean, Sweet Green just reported a terrific number tonight. That's going to send Kava up tomorrow. So let's be careful. Don't buy it on an up day. Buy it on a down day. Michael in Arizona. Michael.
Hey, Jim. I hope today's been treating you well.
The day has actually been a fair, I went to Eddie, I got a good haircut. Sometimes that can make a day. It's like a vacation for me because you don't have a lot to do when you're there. What's up?
Hey, so I've been looking at the consumer discretionary sector, especially following Chipotle's 50-to-1 split in June. And because their fundamentals still look like they're intact, is Chipotle looking like a buy, sell, or a hold, Jim?
I think when Brian Nichol came on, he put to rest that whole notion of smaller sizes, which was all a canard. I said to myself, these guys are back. Now, the one thing that you have to recognize is that this stock sells at 50 times earnings, which is high. But I have been backing Chipotle since, I guess, what it was, well, let's say for 85%, because that's how much it was down when they had that terrible food scare. I don't want to call it more than that because there, by the grace of God, every single restaurant could have had what happened to them. All right, food delivery companies have said they're prioritizing affordability, but I think the real stickiness here is because meal delivery is becoming ingrained in consumers' lifestyles, and it gives them more time. That's why they can keep putting up these great numbers and why they I think they will continue to do so. I like all three. Hey, much more made money, including my suit with Zimmer Biomet. This medical device maker's stock has been less than exciting even though I think their products, especially their new products, are very impressive. I'm getting the latest with the CEO and find out if there's more to the story. Then sometimes your stock is only as good as the sector it's in. I'm giving you some examples and telling you how to react when that becomes the case for one of your favorite holdings. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.